Okay, Maurice, you're still on mute.
Thank you, Thierry. I'm apologize. I had to take off mute. Good afternoon, everyone. I want to say thank you, Thierry, for getting this organized and getting us on to put this together. It's been a very interesting time for us all. A lot of anxiety, a lot of curiosity, a lot of things changing, things just constantly being updated on the go. And what we wanted to do was get as much information to meet of what we've had in these changes in front of everyone, kind of, just give audio, visual to it to give some thought and see how some of this may or may not apply to you, and how to make sure you get the proper counsel on how these things are going to potentially impact you. We covered this presentation in two parts. We considered what would be some individual matters that we're going to be changing, as well as business matters. I will introduce the individual items. Joseph Mondire will talk about the business-related matters. And what we wanted to try to focus on is just what some of the benefits and strategies that can possibly be applied to some of these changes. I just want to say on another note, I hope that you all are finding yourself safe, your families, your loved ones, friends. I'm sure on some level we've probably all experienced people that we know that have experienced being infected with this virus. Some people that we've lost. I've experienced that. It is a very curious time. It's very interesting, to say the least. I am of a belief that we will get through it. It's probably going to take us a little more time than we anticipated, but I think that if we all make sure that we are constantly doing our part, we can collectively get to the finish line. But just wanted to send my regards to you all and what you all may be experiencing, and all that you're doing, and take the proper precautions as we get through this time. With that being said, I will begin to get into the topics. What was rolled out, part of the CARES Act and what have you, was the Families First Coronavirus Response Act, the Coronavirus Aid, Relief and Economic Securities Act, CARES. And so we will go through some of these provisions and things that have been updated that we want you to all take note of. The first thing that came up that we wanted to bring out was just the recovery rebate credit. There will be under the new law, an eligible individual is allowed. Someone may need to put their, if we could get is that better, or does someone else need to go on mute? I do hear some background. But under the CARES Act, an eligible individual can get an income tax credit for the 2020 equal to the sum of the $1,200 or the $2,400 if you're filing a joint return, plus $500 for each qualifying child. Well, what is the benefit of this? Overall, this is a rebate if you're able to get one of these stimulus checks that will decrease your liability dollar for dollar and can be refunded if you have no liability. So it's a refundable credit. If you find that if your tax situation finds you owing, this may be a credit that will definitely knock down some of that liability. It's good that this is being done, because what we didn't want to have, or what we should not be experiencing, is that people get an economic stimulus and then have to pay a tax on it when, through no fault of their own, that they had to even put themselves they were in a position to be able to apply for one. So this kind of offsets the income effect of that, if you will, for those eligible to receive it. And there's no minimum income requirements. The other thing was to just be sure that those whose income is from non-taxable benefit programs like Social Security are also eligible for this rebate. So that was to quell some of those concerns and those questions that have been out there. The credit's good for the year 2020. The strategy and just trying to apply this will be looking at what your adjusted gross income will look like If you have qualifying children, then your filing status will determine what your rebate amount will be. So that's something that we all are going to, if we are eligible, take consideration of that as you go into your 2020 filings. Retirement provisions. The first thing that they put out for us was there will be no 10% additional tax credit for coronavirus related distributions. So previously, if you took money out of your qualified retirement plan, you were subject to the 10% additional tax. So the new law says it will not apply to any coronavirus related distribution up to $100,000. The benefit, hey, you can take out your own money and won't get hit with this additional tax. I mean, it's your money. You're basically borrowing from yourself, so you are absolved of that additional penalty. So, a related distribution that's made after the January 1 of this year and before the end of this year is eligible. The best thing what is the real basis behind this? Well, hey, listen, we're falling, or in some places, or the economic recovery in this may be taking longer than we would like. And that may be impacting people's ability to make their income. So if you have some of this money, you want to assess what your liquidity needs are, and if necessary, pull out what you can to figure out how you'll get through for whatever period of time that you may see fit, or you may be looking or forecasting for. So this is a benefit that those that can do it should look into taking advantage of it. The next provision was a limit on plan loans that were temporarily, or the limit on the plan loans is temporarily increased to 100,000. Repayments are being delayed. So a loan from your plan was typically treated as a distribution unless certain conditions are met. May be additional if diagnosed with COVID-19. So the amounts being increased to the lesser of 100,000 or the present value of your accrued benefit. So this provides that, again, another option for liquidity that you can pay back to yourself with the 1-year moratorium on the loan repayments, as long as you're under, a qualified employer plan, your 401ks, 403bs, etc. Same deal for the period January 1 to December 31 of this year. The strategy behind this was to say if you or your spouse are diagnosed with this coronavirus disease and are experiencing adverse financial consequences, you may be quarantined or furloughed, unable to work due to lack of child care due to the virus, you're encouraged to strongly consider this option, which we think this was a very important one because you forecasted, I guess in putting this law together, they forecasted out how people might actually be impacted by this and what is an additional option they can give to them, as well as absolving the 10% tax. The next one talks about required minimum distributions being waived for 2020. So the previous law, you were required to take your distributions once you reached the age 72 or 70 and a half before January 2020. Well, the new law is just saying, hey, they don't apply for 2020 for a contribution plan or eligible deferred compensation plan, any individual retirement plan. What this is saying is you will not have to take this money out if you don't need it. So this is to help you because you may be at that age when you're like, hey, I don't want to have to pay any additional tax if I don't have to. You may be looking to avoid the additional taxability on your Social Security benefits. This is an idea to just say, hey, which could be interesting because you're already a person in this situation may already be living on a fixed amount of money, so they're trying to manage through that. And if they find that they're able to get through with less without having to and will be able to get through, then they don't want to have this additional income if they don't need it to have to pay this tax on it anyway. So this is something to be considered for those in which it may apply. But it's good that they did this because it gives credence to, hey, why would I have to pay additional tax on money I don't need? So those are all the retirement provisions. Next, we got into education provisions. They put in a tax-excluded education payments made by the employers temporarily include student loan repayments. So up to $5,250 per year, you will get to, you usually had to include, but now the new law says what the employer paid for your student loan, you don't have to include as income this year. So what's the benefit of this? Overall, it's just functioning like you're getting a tax-free loan. They're making these payments for you and you don't have to claim the income. Great. If this applies to you, you would be encouraged to take this. Considering the climate in which employers might even be in, if they're doing this, because then on the business end, they'll look into how it will apply to them. So that's the other point of consideration. But from an individual standpoint, you would want to take advantage of this. Eligible student loan repayments, they're payments by the employer, whether it plays an employee or the lender. They qualify for your qualified higher education loans for the cost of the employee, but not a spouse or a dependent. So you're getting tax-free money here in this instance. So it's always best to, in terms of the strategy, we just say, hey, assess your current benefits and determine its impact when your 2020 filings. See how this may fall out for you and if it's something you want to be able to take advantage of. Healthcare provisions. So now there was changes in the definition of qualified medical expenses. HSAs were created for the purpose of paying for these qualified medical expenses of the account beneficiary that's supposed to meet certain criteria and other requirements. Well, CARES Act eliminates the requirement that these qualified expenses only include amounts paid for prescribed medicine or drugs, but also provides that they include the amounts paid for menstrual care products. And this is the overall point of this. Well, one of the points was to empower individuals to better manage their own healthcare needs and reduce the administrative load on doctors that may be facing strain on their resources. However, that process works. They outline in what defines menstrual care products. They're very specific in what those are: tampons, pad liners, cups, sponge, similar products used with respect to menstruation or other genital tract secretions. Very specific they are about this one. This applies for everything after December 31, 2019. So this is going to be in effect even beyond this year. What we looked at was to say, hey, determine or assess your potential healthcare costs and amounts to be applied for your next filing. So overall, the point of this was an acknowledgement by the government that menstrual care products are necessities, which they are. And the other thing was that they mentioned was period or menstruation poverty or lack of access to some of these products is an issue. And they wanted to be sure that it didn't become something that women could not address or be able to get benefit from in the process of stressing its importance. So, they were very specific about why they wanted to do this. And we thought that this was also a very important law. Oftentimes when we look at what is being changed and why, you really want to drill down to the specifics of why they did that. And, period poverty is something that was mentioned about why they wanted to make sure that there was better education in how to use and access to and benefit of using or having to use menstrual products. Other healthcare provisions. So high deductible health plan, safe harbor for telehealth services. Overall, on this one, eligible individuals who have high deductible health plans can take deductions for contributions made to HSAs. So in years beginning on or before 2021, a health plan will not fail to be treated as a high deductible health plan by reason of failing to have a deductible for telehealth and other remote care services. So effective immediately, these plans can cover these telehealth services before a participant has met the applicable minimum deductibles. Now, when we talk about these minimum deductibles, you got some certain plans that some of us go into because we want to have a cheaper premium. Not necessarily the best analogy, I'll say, but it's like when you buy a car and you say, hey, I don't expect to get in a bunch of accidents or anything, even though you got to really drive to avoid people from hitting you. You're willing to take the risk to say, I don't think I'll have any of these challenges, so I'll take a higher deductible to get a lower premium. But that doesn't preclude the fact that, you may still be in an accident and have to make these, make the necessary arrangements to cover that cost. Here is just basically saying, regardless of how high that premium is, you can still get these telehealth services. And some of those things might be blood pressure exams, ECGs, etc. Some of these more remote or immediate examinations that you may need to stay up on your health and not have to just incur all these other costs just to get looked at or get checked out. So, this is a good thing. This is a good change. This is effective as of the date of the act, March 27th. We just say, hey, determine the need to do this based on the current state of your individual health and well-being and the frequency in which you may need those services, especially if you have one of those types of high deductible health plans. The next area good for under individuals got into the charitable giving deductions. So the background, your adjusted gross income is gross income less certain deductions. Now, the CARES Act allows a deduction of the calculation of your gross income for tax years beginning in 2020 for amount not to exceed this $300 for qualified charitable contributions. So the benefits of this, this will apply to filers who don't always itemize their deductions, and you typically wouldn't get any benefit. Hey, with the Tax Cuts and Jobs Act, you're telling everybody, well, now you get a higher standard deduction, and we're going to limit what you can itemize, with the state and local taxes, et cetera. All of these things that, typically would have automatically made people itemize. Also, people did charitable giving, which you also got the deduction for. Some of the Tax Cuts Act kind of discouraged some of that, at least to the extent of, I don't want to say, well, discourage is probably not the best word, but for tax purposes, you really didn't get the benefit, because you was really kind of stuck at what the deduction would be because you're capped on what you can itemize. So now they're just giving you a chance to apply this additional, giving you the chance to have this as an additional, albeit $300, not, it's not perhaps setting the world on fire, but at least taking into consideration, you can still have some deductions for charitable giving. And also that should still be encouraged amongst us as we, living in an interesting type of time, and, people are making different types of efforts to provide help under our current climate. So, basically just look into making an election for your 2020 return based on what you're doing. And this may just already apply to what you're already doing. So, take advantage of that to the extent that you possibly can. And in charitable giving, there's a modification of limitations on corporate cash charitable contributions. Under the pre-act law, a corporation's charitable deduction could not exceed 10% of its taxable income. So the CARES Act now disregards applying that 10%, and it's been increased to 25%. So qualified contributions will be allowed as a deduction to the extent that the aggregate of those does not exceed 25% of the corporation's taxable income over the amount of all other charitable contributions to the corporation as deductions for the contribution year. Again, a change from 10% to 25%, see how this will apply under your individual situation, and, determine what election you want to make. Then there was an increase in the limits on the contributions of food inventory. And I'm a little excessive in more of the background for this one because I thought, again, you know, there's specific reason, the even more specific reason why this is being done. When we're talking about food shortages and food banks, we have food that is not sellable or going to waste with certain farms, etc. This is something to take consideration of. You know, a donation of food to a charitable organization that used it for the care of the ill or needy, etc., you know, would be deductible. So now it's just basically saying, in the case of any charitable contribution of food during the year 2020, the income, the taxable income limits is 25 rather than 15%. So they're increasing it up to allow us to be able to do more. It allows any charitable contribution of food during the year to be limited to 25% rather than 15%. And this is, you know, this goes on after this is in effect now. So basically, you know, I don't know if they'll make any change to this, but this is probably something that'll go on probably as long as they see fit. We also looked at this and say, what can we do, and, you know, how can you find any benefit of this to you or any strategy? You know, make your elections on the things that you want to look for deductions for. And you're up in this year's returns, and then also considering donating food to prevent that potential waste. So this is just one of those things that, you know, specifically because of what's going on with nutrition and access to food and potential things that may come on down the road as we, you know, continue to get through these crisis matters and just overall shortages in certain places. And for places that you may know directly, this could potentially apply to you, and figuring out if there's some way that you can provide that help. Those cover all of the individual items that we wanted to go through. We are now going to move over to the business matters associated with that, and I will turn that over to Joseph, and he will walk you through the updates on these related slides. Joseph.
This is Michelle from Philadelphia. I'm sorry to interrupt. I'm getting ready to bounce off, but this is awesome information. Would you guys be able to make this PowerPoint presentation available to us afterwards?
Absolutely, Michelle. How are you? We'll be able to do that.
I'm well, thank you.
Good. We can probably get it PDF'd and sent out, but we'll speak with National and just see how they want to move forward with that.
I would love that. I'm literally like forwarding information to my employer right now as we speak, but thank you so much.
Not a problem. All right, be safe.
Thanks.
You too.
Joseph, you can proceed.
I see him on here. I think he's trying to work out his microphone.
Yeah, I see he is off mute. Can you hear us, Joseph?
All right, he can hear us. He may have. It looks like he's going to have to phone in to get his microphone operable.
Okay. If he wants to try that, that's good. In the meantime, I'm not sure. Would you like to take questions, Maurice, or did you want to wait until the end?
I mean, I still want to wait. I mean, because we can get through them all at once. I don't know if I see any in in the chat box right now, but you are, for all of you that are on, you are welcome to enter any questions that you have in there, and we will go through them and get to address those as we conclude.
Can you all hear me?
Yes,
Yes,
Joseph.
we can.
Yes.
Okay, here we go. I don't know what's going on with my computer today, but right before this started, I wanted to start acting up, so I apologize for that. But Maurice, if you don't mind, I'm going to ask you to control the slides for me.
I guess you covered.
So, okay. So as he mentioned, I'm going to go over the business aspects of the changes in legislation that have been passed in the last 8 weeks or so. And really what we focused on is not necessarily specific to any particular industry, and it's just really business-wide. It's just if you have an EIN, this has a potential to apply to you. So that was the focus for this. And if anybody has any industry-specific questions, again, we ask that you hold them to the end, and please feel free to just put them in the chat box. First, we have the Employer Retention Credit for employers. So the new law is that there is a refundable credit, payroll tax credit for 50% of wages paid by employers against the 6.2% employer Social Security. So if you're an employer that regularly issues payroll, you know that you have payroll tax that's due every time that you issue payroll. So a portion of it, the total is 7.65%, and that is split between 6.2% to Social Security and 1.45% to Medicare. So the 6.2% that you pay to Social Security, up to half of that is refundable to your business through the form of regularly issuing your payroll. But when you file your 941, if you typically file that as you do at the end of a quarter, but this time for second quarter and moving forward for the rest of this year, so that'll be from April 1 through December 31, there will be a refundable credit that you can receive for every employee up to $5,000 of their wages on your 941s. You also have the option of filing the IRS Form 7200, which is an advance payment of the employer credit, but you can't do both. So you're either going to receive the refundable credit when you file your 941 at its regular due date, or you will file the 7200, which is a new form for an advance of the credits. So the option is available. And in dollar figures, it's approximately about $300 per employee. I want to say like $310. And so, I mean, it's not the biggest credit, but it is a resource that's available to all businesses who have employees and maintain their employees through this crisis. And again, this period covers through March 12th, so all wages paid from really the 13th through the end of the year. So March 13th was a Friday, so the beginning of that new pay period or the end of a pay period all the way through the end of the period that will be included for the December 31st, which will be a Thursday of this year. You can move on, Chuck. Thanks. So delay of payment of employer taxes. So employees that have received a payroll protection loan can defer deposit and payment of the employer share of Social Security tax that otherwise would have been due as of March 27th of this year, a few weeks back, through the date that the lender issues a decision to forgive the loan in accordance with paragraph G of the section 1106 of the CARES Act. And if you do decide to defer this payment, you won't have any failure to pay penalties. Once an employer receives a decision from its lender that the PPP loan is forgiven, that employer is no longer eligible to defer deposit and payment of the employer's share of the Social Security tax after that date. So you have a bit of a window through when you originally apply for the loan and when you get approved for the loan and the decision to ultimately either forgive that loan completely or not. So that's the window that you have. You can move on. Thanks. credits for paid sick and family leave. The FFCRA gives businesses with fewer than 500 employees, refer to these as eligible employers, funds to provide employees with paid sick and family medical leave for reasons related to the outstanding coronavirus, either for the employee's own health needs or for care of family members. Workers may receive up to 80 hours of paid sick leave for their own health needs or to care for others, and up to an additional 10 weeks of paid family leave to care for a child whose school or place of care is closed, or a child care provider who is closed or unavailable due to the coronavirus. So pretty much every school and daycare is closed in this area. So this applies. And it covers the cost of this paid leave by providing small businesses with refundable tax credits. Certain self-employed individuals in similar circumstances are entitled to similar credits as well. And the period is 4/1 through December 31, so second, third, and fourth quarter in its entirety for the remainder of this year. And it covers employers dollar for dollar reimbursements through the tax credits for all qualifying wages paid, including health insurance coverage. And this is also filed through the 941. Go ahead, Chuck. Temporary repeal of the taxable income limitation for net operating losses. So the CARES Act temporarily removes the taxable income limitation to allow net operating losses carry forward to fully offset income. For tax years beginning before 2021, taxpayers can take a net operating loss deduction equal to 100% of taxable income rather than the 80% limitation in the previous law. For tax years beginning after 2021, taxpayers will be able to take 100% deduction of net operating losses arising in tax years prior to 2018, and a deduction limited to 80% of modified taxable income for net operating losses arising in years after 2017. The provision also includes a technical correction to the 2017 TCJA relating to effective date of the net operating loss carryback repeal. The amendments made apply to tax years beginning after 12/31/17. So 1/1/18 was the beginning of the enactment of the Tax Cuts and Jobs Act. So this is that same period, and to years beginning on or before 12/31/17, to which net operating losses arising in tax years beginning after 12/31/17 are carried. So prior to the CARES Act, the amount of net operating loss deduction was equal to the lesser of aggregate of the net operating loss carryovers to such year and net operating losses carrybacks to such year, or 80% of taxable income computed without regard to the deduction allowable in this section. So ultimately, net operating losses were currently subject to taxable income limitation, and they weren't able to fully offset income. So this is a benefit. You can move on. So the modification of rules related to net operating loss carrybacks. So the old law, net operating losses for any tax year was carried forward to each year following the tax year of the loss, but isn't carried back before the year of the loss, which I just said. And the new law is net operating losses can be carried back to each of the 5 previous years preceding the tax year of such loss. So REITs and real estate have their own rules, which I'm not going to go into details about. But it's any period after 12/31/17, so 1/1/18 and beyond, and before 1/1/21. So through January 1st of 2018 and until 12/31/2020, the end of this year, this applies. And the benefits are it offsets previous year income tax returns that needed losses to lower their income. And it will be properly reflected when filing your annual tax return, or if you need to amend your return because you've already filed. And you need to determine whether you have net operating losses to carry back to those previous years to figure out if this can apply and how to ultimately benefit you. Next, modification of limitation on losses for non-corporate taxpayers. So the old law was excess business losses were disallowed by pass-through entities. The new law is you can deduct 2018 and 2019, along with 2020 through 2025 excess business losses. And so any losses arising in a tax year beginning after this calendar year, so starting next year 1/1/21 and before 1/2/26, which is the period that is still applicable through the original Tax Cuts and Jobs Act that was enacted previously. The benefits are pass-through entities can take more losses than they could not take previously. And so you need to, this can also be done by properly reflecting when your annual or amended tax period return was due. Again, if you've already filed your return for that period, if you need to amend it, look at your losses, see what is available to you to take as a loss, and then file amended returns as need be. Next. Have you moved on? I can't. Okay, here we go. Deductibility of interest expenses. So business interest under the original Tax Cuts and Jobs Act was limited to 30% of taxable income. So the new law is that has been increased to 50%, except for partnerships for this year only. So for 19 and 20, you can deduct up to half of your business interest as a business deduction, as a deductible expense. And you must elect to calculate the 2020 business interest using 2019 adjusted taxable income. The new temporary rule applies to most businesses, excluding partnerships. Again, so if your business operates as a partnership, you're still subject to the 30% limitation for the 2019 tax year. Excess business interest can be passed through to individual partners or carry forward. So for the 2020 year, partners can take 50% of the deduction for business interest expense. Any remaining business interest could be carried forward. Next. So forgiveness for the Paycheck Protection Program loans, we kind of talked about that previously. So this is a loan that you have applied through your existing relationship with your current financial institutions. Each business can only apply for one loan at a time, and if you guys aren't aware, they are able to check that. So if you say you have a business that has bank accounts at two separate institutions, you can only apply for one loan as a whole. So if you have an application started at one institution, but there may be a disconnect between whether your information was provided timely or maybe you didn't get approved for the loan. If you try to start an application at a second institution while you're still in the process of the first one that you've applied for, it will delay your process significantly. So you can only do one at a time. You can only do one, excuse me. And again, there's an opportunity for the loan to be completely forgiven if the money is spent in accordance with the guidelines set forth.
One thing I wanted to add on that, in applying for your Paycheck Protection Program loans, if you are going through two separate institutions, you really got to be careful because it can be tricky. If one finds out about the other, they may just deny the application in its entirety, and from there you have to just continue with the other applications you may have submitted. So it really comes down to getting a decision on what you submit first to determine where you may go next. But it's real touch and go, and we know some of this money is quickly being applied for, and it's probably close to drying up at this point. But for those of you still applying, just be mindful of that, or any correspondence that you may be receiving could possibly be a result of that.
All right, corporate minimum tax credit is accelerated. So the CARES Act allows for corporations to claim 100% of the AMT credits for 2019. It also provides for elections to take the entire refundable credit amount in 2018 as well. So this is done through the 8827, the credit for the prior year minimum tax for corporations. And again, you just have to assess whether or not you have a tax credit carry forward reported on your 2018 filing. And this applies for C Corps because they're taxed as their own entities, not like the pass-throughs, S Corps and partnerships, which are taxed at the individual partner level. Aviation excise taxes appeal, suspended excise taxes imposed for 3/28 through 12/31 of this calendar year. Go ahead, move on. Excuse me, bonus depreciation technical correction for qualified improvement property. So the old law, Tax Cuts and Jobs Act, allowed 100% of bonus depreciation for qualified improvement property, i.e. non-residential. So there was an issue that was incorrectly excluded leasehold improvements, restaurant property, retail improvement property, and recovery generally 15 years. And the Tax Cuts and Jobs Act made it 39 years. So the new law says the mishap has been corrected to 15-year property subject to 100% depreciation. Any property placed in service after 12/31/17, so 1/1/18 and moving forward. The benefit is there's retroactive treatment for 2018 and for the 2019 filing. So again, if you need to amend your 2018, that is an option for you. And there's no specific guidance yet on one-time adjustment or the amendment. You just have to see if you had any qualifying property improvements in these categories that you did not get the 100% bonus depreciation on. Some other considerations on a state level, states either conform with the feds on a rolling basis or on a fixed basis, legislation is needed, and selective basis, which is by section. You could defer for corporation and personal. So really, every state really is up to their own discretion how they want to move in terms of all of these changes that are taking place now. And so you really have to be in contact either with your your own tax preparer, or look on your state's websites to see what changes they've gone 100% with the feds on versus ones that they're taking into their own hands. I know that Virginia has pushed back their filing deadlines, but it wasn't to the July 15th deadline that the federal government pushed back their filing deadline for anything that was due between April 1st and July 15th. So anything that was due from April 15th, so your personal income tax return, your C Corp return, your estimated payments for 2020, all of those originally had your first quarter estimated payment due date was all April 15th. That date got pushed back to July 15th, but that was only for the federal returns. So for any applicable state return that you file for 2019, you have to check with that state because they're not all lock and key with the federal government in pushing the due dates back to July. The IRS operations, they are not accepting phone calls. The last few times I tried to call, everything is done pretty much by mail or online if you have online accounts. So you can also fax, and a lot of people have been significantly impacted by that, including some of our clients who we don't have online accounts set up for. So it has been a serious drawback. If you're looking for your individual payments that Maurice previously discussed, you can go to the IRS website and click the link for Get My Payment, and you may need to access the frequently asked questions section to figure out what you need to do if you have not received your payment yet and how to expedite that process. The other thing is the IRS never calls, texts, or emails regarding the economic payment. So if you do receive correspondence from them that's not written, there is a likelihood that there's fraud associated with that correspondence. And so they're never going to ask you for your payment information over the phone. They're not going to call you and ask you, hey, this is the IRS, we're looking for your wiring instructions. So they're not going to call you for your routing or your account number, because that's not how they operate. And again, if anybody has any questions, I see there are some notifications in the chat box. So let's see what we have.
So we saw a comment in here about the guidance by the SBA on applying at multiple banks to complete your PPP application. And then there's a comment about what if you applied directly through the SBA. There was a lot of folks who they mentioned speaking with that slowed the response of the agency. Applying for your PPP, you don't do that directly through the SBA. You do it through your bank. Your bank should have a portal or a link or a website that you can go to begin to submit that application, and you upload your related documents and complete the information from there. And then they will get back to you on anything additional that they need for you to follow up. If you are doing it through multiple banks, which you're not being discouraged to do that, but the point in doing that is somebody's going to get receipt of your information first in doing that, and it probably will be maybe the first bank you apply to. It depends. These institutions are so overwhelmed in response and being able to get a quick response out, especially for those, where either politically speaking, it may not be of a certain amount, or if it's not, what's in it for the bank to make their money off of these, because hey, the bank is still trying to figure out how they can economically impact from doing some of this as well. But whoever gets that notice first will be looking to look to see if you've applied elsewhere, as well as the place that didn't get notice first. They're looking too, and then whoever finds out, they'll kick it back and just say, hey, we see you've applied elsewhere, they're closing you out, and that pretty much should be it. I guess the best way to look at that is you're trying to kill two birds with one stone. So you're throwing up against the wall to see who's going to stick. So to that extent, you're encouraged, but that's just the catch, so that they know that you're not going to be able to get more than one. I don't see any other questions. If there are, you can go into the chat box, but we want to just say that this information will be disseminated through National for anyone that wants to have it and refer to it, etc. You've seen it. This presentation has also been recorded, so we have made history in that regard, and we're happy to do that. You can contact us also with any questions. You see our Twitter. We also have a blog. We've been putting a lot of information out there to just kind of keep everyone in the loop and keep folks informed of all that's going on and things that are constantly changing. So, continue to be on the lookout, and of course, govern yourselves accordingly. Be mindful of, any and everything that you can possibly get in front of you concerning, the economic impact of everything that we're dealing with, because that's the biggest thing in the news right now is when's the reopening versus vaccines, and how do we continue to slow the spread, and if anybody's going to abide by the 14 days, etc. There's so much going on. There's so much to consider. While the overall consent of most of us who've I guess taken a poll or whatever just suggest these distancing rules continue to stay in effect until we see a slowdown of the spread, and we try to do as much as we can under our remote environments as some of us currently are. Now that's for some of us who are in professions where that may benefit us. We may have that advantage, but for those who don't, it continues to be an even more curious time. But we all are impacted by this, and we still are all in this together. So it is a matter of us just being diligent in these guidelines set forth, which are really for our public safety, our health, and our ability to stay alive. And I think, that's probably is equally important, because if we're not here, I don't know what kind of economy we have. So just some thoughts for the mind. But thank you for your time, and that concludes our presentation. And I'll turn it over to National, and you can close us out.
Okay, thank you, Maurice and Joseph. That was a very informative information that you provided us. So I'd like to thank everyone for joining us. As Maurice stated, we will follow up with a recording, a link to the recording, as well as a post-event survey, and then someone also requested a PDF of the presentation. So all three of those will be included in an email that will be sent to you in the next day. And please note that we have additional webinars that are coming up in the weeks to come. You can check comptonational.org for the list of those webinars. And I'll just give you a sneak peek of what we have coming next week. On May 14th, we have a hub webinar. On May 28th, we have a webinar on thriving in the new economy. And on June 4th, we have a webinar on emotional intelligence during the crisis. So I'd like to thank everyone, and please have a good afternoon and enjoy the rest of the week, and be safe. Thank you very much.